Hello, I'm Bernard Hickey and welcome to the Investing Report on interest.co.nz. Today we have news that Lombard Finance and Investments has defaulted on over $120 million worth of investments. It's now seeking a moratorium on interest payments and capital repayments on that $120 million. Lombard was widely advertised its products and used the catchphrase, invest wisely. You might have seen those Roman columns which appeared to show it to be quite a solid investment. Unfortunately, it wasn't. It lent almost exclusively on property developments and real estate. And the problem was the property slump, starting in November, really ratcheted up the pressure on finance companies like Lombard, who are exposed to the risky end of the finance sector. So people who had apartments or coastal property, who'd borrowed perhaps 100% to invest in these, when they got into a little bit of strife and tried to sell those properties, they couldn't, and therefore couldn't repay the loans that Lombard was calling in. Now, Lombard's chief executive, Michael Reeves, has called this a systematic failure of an entire industry. He's suggesting that Lombard is just a victim of something that's going to affect everyone. But let's have a closer look at that. Now, Lombard liked to present itself as a solid, safe company. Its chairman is the Right Honourable Sir Douglas Arthur Montrose Graham, a former National Party cabinet minister. And there are a couple of other cabinet ministers in that board as well. Hugh Templeton, although he's no longer a director, and Bill Jeffries. But the trouble was, behind the scenes, Lombard wasn't as safe as some other finance companies. It was investing heavily in the real estate sector. The convictions of Alan Beddy, the chief financial officer who resigned a year and a half ago, and Michael Reeves weren't widely reported, unfortunately. They related to $14.5 million worth of contributory mortgages written over 5 years ago. And Lombard's been in trouble before on contributory mortgages. Back in 2005, there was a flurry of publicity around some people who'd lost a third of their money in contributory mortgages written by Lombard. And Lombard has also been involved with some other players who've been in trouble, in particular Blue Chip Investments. Lombard bought the brokerage Tasman Mortgages from Blue Chip last year. And just at the end of the year, Lombard bought $230 million worth of mortgages from Hanover. Now, this collapse of Lombard, or its move into moratorium, brings the total amount frozen in finance companies in New Zealand in the last 2.5 years to $2 billion, just over $2 billion. The confirmed losses, we calculate, are now at $761 million. Now, given that quite a few of the companies haven't actually collapsed yet, that many of them are in moratoriums, if we carry through the loss rates in the ones that have collapsed to the ones who are in moratorium, we're looking at projected losses of $1.18 billion. So where to for now? What if you've got your money in a finance company and over $10 billion is still in finance companies in New Zealand? What do you do when it comes time to reinvest? Well, firstly, look to see if the company has an investment grade credit rating. That's anything from Standard & Poor's that is BBB- or better. And currently, South Canterbury Finance and Marrick Finance have investment grade credit ratings, and UDC also has an investment grade credit rating, mostly because it's owned by the ANZ Bank. Also look for high interest rates. Something that is risky should be offering higher interest rates. And currently, you'd expect finance companies to be charging or offering 2 to 3% more than in the bank. And overall, be careful. I'm Bernard Hickey for interest.co.nz. That was the Investing Report.